Good evening, everyone. Welcome to Let's Trade Live. This is Wayne, Head of Research and Education. On behalf of Fullerton Markets, I warmly welcome everyone. As usual, the webinar will be divided into three segments. The first segment will look at what are the key events and news that has happened in the past 1 week. Second segment will move on to the calendar for this week to look for any trading news or data that to watch out for. And finally, we move on to the final segment where I open it to the floor to type in your requests. As usual, feel free to type in any questions that you may have. I'll take the question along the way. Very quickly, yes, last week was, all the focus was waiting for Fed Chair Janet Yellen's monetary policy report. Is a 2-day statement. Basically, to summarize, this is a part of the statement that was prepared by Fed Chair Janet Yellen. Just to highlight the first one, she reiterated that they expect the economy growth to warrant a further gradual increases in federal funds rate. So as you can see highlighted on the screen, it means that they are still looking for a gradual tightening of their policy. In other words, gradual increase in their interest rate. And the other key thing to take note is this, waiting too long to remove accommodation would be unwise. Okay, what this sentence means, accommodation means to keep interest rate low. So it says waiting too long to remove accommodation means waiting too long to increase interest rates or waiting too long to tighten their policy would be unwise. So that means this is a clue that if the situation warrants it, there could be a possibility even in March there could be a rate hike. So that's what the statement mean. So of course last week if we watched especially dollar yen is a bit tricky. So given the data for last week is also quite positive with the CPI outperforming, with most of the US data outperforming, plus Fed Chair statement is also considered more hawkish than what the market anticipated. So by right, dollar yen supposed to rally, but it closed below 113 instead last week. So anyway, for those of you who have read our weekly research, which was published in the afternoon, you will notice that the key reason is because for dollar yen, it tracks the US Treasury yield. So for the US 10-year and 30-year Treasury yield, both actually declined towards the end of the week, causing dollar yen to decline as well. But having said all this, because the data at this moment plus the central bank intention, given these two, it is favoring dollar to strengthen fundamentally. So later, if some of you are keen, you can type in the request to look at dollar yen. We'll talk more about dollar yen and any upcoming trading opportunities to consider. So that's about it for last week. So quickly, let's move on to this week's calendar. So this is Wednesday, 22nd February. There are some data to watch out for, and this is one of them, the UK GDP. Of course, it is scheduled to release at 5:30 p.m. GMT plus 8. I have queries coming in asking what is GMT plus 8. So quickly I shall answer it. GMT plus 8 is basically the time zone, and this time zone represents the time of countries like China, Malaysia, and Singapore. So meaning to say GMT plus 7 is they are actually 1 hour behind us. So these are the Thailand and Indonesia time zone. So anyway, the upcoming one, which is Wednesday 5:30 p.m. GMT plus 8. So this is the UK GDP. The forecast is 0.6%. So the suggestion over here is a pending short for pound dollar if the actual data is less than 0.5%, meaning to say this suggestion is targeted at the actual data being 0.4% or lower. So if the actual data comes up as 0.5%, 0.6% or higher, then it doesn't fulfill the criteria for a pending short. Next data will be at night, 9:30 p.m. GMT plus 8. This will be the Canadian retail sales, excluding automobile. It means the core retail sales. So the forecast is 0.8% increase in the retail sales excluding automobile. So here's the suggestion. A pending long dollar CAD if the number is less than 0.4%. So if the actual data is 0.3% or lesser, then it fulfills our criteria for this pending long dollar CAD. In case some of you are asking how come if it's less than 0.4% it's supposed to be worse data for the Canadian, why do we put a pending long order? So do take note that because for dollar CAD, Canadian dollar is on the right hand side. So if the Canadian dollar weaken, dollar CAD goes up. So that's why if it is bad data for Canada, then dollar CAD is likely to go up. So this is the suggestion for Wednesday night, Canadian core retail sales. Of course, on the same day, early in the morning, 5:30 a.m., Reserve Bank of Australia Governor Philip Lowe is expected to make a speech. Of course, this is not the typical rate statement or whatever, but whatever he say will definitely may or may not have some impact to the market depending on what he's saying. Of course, if he says something that is not inside his previous statement or his giving a new perspective, of course that may move the Aussie a bit. So if the purpose of highlighting this, of course we will not be able to know the exact content of the speech being made until he made it. So the purpose of highlighting this, of course, is so that for those of you out there, if you are holding any Aussie position, any currency pairs that has Aussie dollar, example Aussie dollar itself, or pound Aussie, or Aussie Kiwi, so any currency pairs that has Aussie dollar as one of either the counter currency or the base currency, do watch out for if you are holding the position past Wednesday morning, 5:30 a.m. GMT plus 8 time, because that during that time when the RBA governor make a speech, then the Aussie may have some volatility. So on Thursday morning as well, we're in the 3 a.m. GMT plus 8 time zone. There will be the FOMC meeting minutes. So it is detailed meeting minutes of the previous FOMC meeting. So again, the purpose of highlighting this meeting is for traders out there to be aware if you are holding your dollar-based positions across Thursday morning. So any of the dollar majors, if you are holding it past Wednesday night, into a Thursday morning, because most of our client or traders are within GMT +8 ± time zone. So chances is during 3 a.m. plus minus, it could be 1 a.m. your local time or 4 a.m. your local time. Chances is most of us will be sleeping and will not be able to monitor the market. So be aware, on Thursday 3 a.m. there's FOMC meeting minutes. There could cause some volatility in the US dollar as well. Of course, if you ask us, we are not expecting any surprise from the meeting minutes. It should echo what the Fed Chair Janet Yellen has spoken last week, meaning to say they are still on track for tightening, or they are looking out for gradual tightening if the data supports it. So there's so much for this week's calendar, and before we move on to the charts, again, like to highlight for those of you who have yet to open an account with Fullerton Markets, do check us out. This is our most popular and most taken up promotion. It's called the Accelerator. You can get up to USD 10,000 for free. Do check us out and check out the terms and conditions as well. fullertonmarkets.com/promotions. So we are moving on to the final segment. Let's go to the charts for trading opportunities. And this is the time where you will type in your requests. I'll take them in a first come first serve basis. So while you are typing in the request, basically for last week, we have not gone through much of the chart. A bulk of the time was taken up when I explained how exactly I trade the news using the 5-minute chart. So for those of you who have missed our last week webinar, you may log into Fullerton Suite and review that part of the webinar. And then of course, those of you who have yet to be our client, of course you won't have access to our Fullerton Suite. Fullerton Suite is an admin portal that is given to all our client who has a live account with us. So once you have a live account with us, you will be able to access all the recordings of our past webinars, any webinars, and other videos as well. So for last week, we have basically looked at two chart, the pound dollar and the pound yen. And this is pound dollar. Basically, at the point of the webinar, I mentioned that I prefer to trade the UK data for last week, because there's quite a number of data scheduled to be released last week on the UK side. So that's the reason I gave this comment. And the second chart that we looked at is basically pound yen. And of course, since it is also a sterling pair, my comments remain the same as the previous one. Prefer to trade UK news on this pair. Of course, I went one step more, meaning to say if someone really wants to trade, then that's the two suggestions they have given, one for long, the upper blue box, and one for short. Of course, the short one, technically speaking, is triggered first, but as you can see, the market has been hovered for quite some time before this long bear candle that shot all the way down. So without looking at the news calendar, there's a reason for me to suspect this could be during a news release or something that have announced that caused this kind of violent movement. So even if it's not because of news, if you look at it from a purely technical point of view, our criteria is if the candle closed at the blue box or lower, it's fine. we will go in for a short. But in this case, you'll notice that because of this long bear candle, by the time the candle closes at the end, it is close to the green box, which is the first target that I have intended for this trade. So if such things happen to me, this to me will be a void trade. That means that I will not go in, even though yes, it closes below the blue box. But if you look at it, it is just like pips away from the target. So there's no point entering this trade. Within a few pips, it's hit my first milestone. And chances is for this trade, the stop loss, I have to put it fairly way high up. So this could be a jolly well like 8:1 risk to reward kind of trade. Risk reward 8:1 means you risk 8 portion, and if you make a gain, it is only one single portion. Example, if you risk 40 pips, your gain is only 5 pips. This is 8:1 risk to reward ratio. So this would be a void trade for me. So this is about it, the 2 charts that we have gone through last week. Okay, let's look at the request for this week. Let's not waste time. Okay, before I take the request, there's one interesting question. This week seemed like a quiet week. Does that mean traders should stay out? Any suggestion of pairs that maybe possibly be the star for this week? Interesting question. But if you read our research for this week, yes, the amount of data is a bit little. There's not much of data scheduled to release this week, and there are no major scheduled announcement to be made by central banks, except for RBA meeting minutes and the FOMC meeting minutes. Okay. So chances is we do expect these 2 meeting minutes to just reiterate what the central bank has said after their interest rate announcement. We do not expect big surprises. But having said that, it could mean that it doesn't mean the market will be quiet, because there are so many traders around the world at any one point in time. Definitely someone somewhere will be trading the market. So in our weekly research, we mentioned that this week could be a good week for trader to apply technical trading. That means look at the support, resistance, candlestick patterns, chart patterns, or rely on indicators to tell them where to go long, where to go short. So it could prove to give a lot of good trading opportunities for technical traders. Okay, the next question, what is the strategy to trade on important announcements? My trade exited early several times due to high volatility. To answer this question, because some trades exit with profit due to high volatility. So high volatility doesn't mean it's always bad. Because of high volatility, sometimes it gives trader opportunities as well. So of course, if you want to find out that there are many strategies out there to trade during news, but if you want to find out my personal way of trading the news, you can watch the webinar for last week. And usually during the second segment of every week's webinar, Select Trade Live, I'll highlight data suggestion, and also I will highlight my criteria of putting a pending order, and that's basically how I trade the news. I use pending order instead of entering instant order prior to the news. Okay, let's move on to the request for this week, which is the first one is dollar yen H1. Okay, let's look at dollar yen H1. So this is a dollar yen chart. H1. In our weekly research, we actually mentioned about dollar yen as well. We mentioned we put a 4-hour chart actually. We placed a 4-hour chart, and we have put the round number as a support. So I'll just put it here for our reference. Then I'll switch back to the 1-hour chart. Okay, 113 is the level that we think is likely to hold for this week. Reason is because two main reasons. The first one is the Federal Reserve is still on a tightening mode, and based on their statement, there's still a chance of a rate hike in as early as March. Okay, the chance may not be as high as 70-80%, but it could be around 40% now. And 40% is considered pretty high since it's close to a 50% chance of a rate hike. So fundamentally, Fed Reserve tightening plus let me see, Fed tightening is supporting a strong dollar fundamentally, plus of course the data that has been released recently, be it jobs data or the CPI, etc. It is supporting the Fed to raise their interest rate earlier rather than later. So be it data or even the monetary policy, it is fundamentally supporting a strong dollar. So for this week, since there are no major US news or announcement scheduled, we do expect the 113 round number to hold on, and possibly dollar yen could hit higher. So having said that, I personally would prefer to look for an entry to go long instead of going short on dollar yen. So this is the H1 chart. It has dropped fairly in the last 1 week or so, in the towards the mid and end of last week it dropped. Okay, for reason because of the treasury yield is dropping towards the end of last week as well. So looking at the current chart, I'm going to zoom in so that it is easier to see it on your screen when I explain. So short term wise, I'm seeing a short term resistance over here. Which is around 113.18 plus minus thereabout. So I put the blue box over here. I'm going to change it to green color so it represents the entry area. So meaning to say, if the candle close inside the green box or higher, if it close inside the green box or higher, that would be my signal to go long. And the upper blue box is actually the first milestone for the trade. If it hits, this is about 20 pips away from the entry price. So if it hit into the blue box, then that is where I would shift my stop loss to at least break even. And at that point, may decide to either close off half of my position or I leave it running for higher profit. So the next target would be over here where my second blue box is. So I'll put some price label so you know roughly where are those price levels. Plus minus a few pips is fine. I'm not so concerned with the precision. So the first box is about 113.45 plus minus. Second box is about 113.75 plus minus. And for me, I will place a stop loss over here. For this trade, I prefer a slightly conservative stop loss. That would be where I would place it to the other side of this tight consolidation, which is around 112.95 thereabout. So for those of you who think that dollar yen may go further because of a safe haven, whatever reason, if you hear or see any news that comes out throughout the week, this week, that favors safe haven because they're sparking more fear and panic, causing the yen to strengthen. Of course, if you hear such a news, then possibly you could look to go short. But chances is when that happens, dollar yen would have gone down further. So this is my suggestion for long. Okay, fundamentally, the reason I don't look for short trade, I'll write it here as well. So I put my comments over here so that we can review it next week. Okay, my preference, that's my preference, and my reason is stated below as well, because US data, which is pretty healthy, and also of course Fed bias. Fed bias means they are still looking at tightening. Supports dollar bull. That means supports dollar to strengthen. So that's dollar yen. Let me move on to the next request. Aussie dollar H1. Let's look at Aussie dollar H1. Okay, this is Aussie dollar H1 chart. So as you can see, the entire chart, there's no clear trend, clear obvious trend. Be it an uptrend or a downtrend, there's no obvious direction. And if you look at the fundamental side, yes, the CPI from China is improving, surprise on the upside, so that gives Aussie some push. But if you look at it, the US dollar is also on the strong side. So if you look at this pair, imagine it in a tug of war, it would be a strong team versus a strong team. The Aussie and the dollar, if the Aussie is stronger, it will pull the Aussie dollar higher. Of course, if the dollar is stronger, it will pull the Aussie dollar lower, this currency pair lower. So at this point, both currency are considered fundamentally strong, on the strong side. So of course, to trade this pair, since there's no preference on the fundamental side, then the other way is to look at it from a technical point of view and to look for any trading opportunities. And on the technical side, there's no obvious uptrend or downtrend. So I would apply again support resistance to tell me where are the possible decisions area of the market. That means area whereby decision is being made. So I'm going to put in the region. Okay, the immediate one of course is 0.7685, and the below one is 7655. Just give me a moment. Okay. So this would be the two regions that I'll be watching out for. So once price hits into the region, which is around 0.7685 or 0.7655, these two area is basically what I call decision area, where market is likely to make a decision. So I'm going to change the color of the area. Okay, this will be the area. That means there are possibility of 4 trading opportunities. I'll mark them in green box to explain. Okay, so we'll start off with the lowest green box at the bottom. So when price hit into the orange area, then the next thing I want to see if the price close lower. Okay, close lower into the green box or lower, that would be my signal to go short. However, if the price did not breach the area of 0.7655 plus minus, and then it retrace up to the green box. So if there's a bullish engulfing patterns or there's a bullish candlestick pattern that gives me an entry in the green box or around the green box or slightly higher than the green box, that would be my entry to go long. And similarly for the third green box, I want to see price hit into the orange area, and then once it turns down, give me a bearish candlestick formation, and that will be my signal to go short. Of course, if that did not happen, prices go beyond and close higher than 7685, close into the top green box or higher, that would be my signal to go long. So for this Aussie dollar, I've seen 4 different possible trading opportunities. So of course the price is in the middle of nowhere now in my point of view. So from here the price is 0.7667. From this point, price can go either up and down. I'll just stay and watch until my criteria is fulfilled before I go in for a trade. Okay, some of you have requested Aussie Dollar H4, but I've covered Aussie Dollar H1, so I'll keep it as H1 in order not to confuse everyone. Yeah. So thank you for the reminder to put a vertical line for current time. Thank you very much. I'm so glad that I get a reminder. It just shows that you have been attending or supporting my webinar. So thank you very much. Okay, I'm zooming in the chart so that now it becomes more visible. And I'm going to put some price labels so you have a reference to the green box. Okay, roughly what are the price area that I'm looking at. Okay, the bottom one is about 0.7650 plus minus. That's where the green box is. For this green box is about 7660 plus minus or higher, 7660 or 7661 or 2. And this green box is about 7680 plus minus. And the top one is 7690. Thereabout. Okay, there's a question. May I ask a question, please? Why is Aussie always so tough? When you mention why is Aussie always so tough, it is not always so tough. It depends on which time frame you are looking at, but if you track back, Aussie has been weak in a way since they start slashing interest rate. So every time they slash their interest rate, it becomes weaker and weaker. So until recently, where they slash until a record low of 1.5%, and unless there are reasons to believe RBA will slash the interest rate further, chances is the Aussie may not weaken as much compared to last time. And also RBA has mentioned that at this moment they can't decide whether Aussie dollar is too strong or not. Meaning to say it's okay for Aussie dollar to go up, because in the past few years, because of the economy and the growth, RBA doesn't like Aussie dollar to be too strong for obvious reason. They want to export their raw materials, so with a weak Aussie dollar is better for their exports. And also with a weak Aussie dollar, it helps to help them to recover from their inflation, meaning they have set a target, but so far inflation has fallen short of their target. So if the Aussie dollar remains weak, it will help their recovery and also help the central bank hit their inflation target. So on the opposite side, if Aussie becomes too strong, it will hamper their so-called effort to hit their inflation target. So in the last few years, we have always heard when the Aussie dollar strengthened too much, RBA will tend to so-called jawbone it lower. So it will say things like, oh, I think the Aussie dollar is too strong for the benefit of the Australian economy. But in the recent statement, they have come to a point whereby they can't justify the Aussie dollar is too strong at this moment. So meaning to say there's a possibility that even for Aussie dollar to go higher, the central bank may be feeling comfortable as well. And if you look at the China side, there seems to be a bottoming up of their slowdown. Yes, China has been slowing down, but the rate of slowing down seems to have tapered. As we can see, even their inflation rate has outperformed recently. So it could be a sign of a rock bottom. And once China hit rock bottom, let's say for example, then the next thing, of course, it will be to look forward to would be a gradual growth from China. And if China return back to a gradual growth, something closer to the 7% GDP, then that would be a boost to Australia's economy as well, since they are still the largest trading partner. I mean, China is still Australia's largest trading partner. Australia may not be China's largest trading partner, it's the other way around. China is definitely still Australia's largest trading partner in terms of imports and exports. So these are some of the reasons that I feel that to keep the Aussie dollar strength, holding up the strength of the Aussie dollar. Of course, we all know that for forex market, it is always trading the relative strength. So even if the currency is strong, if another currency is stronger, it will mean let's say for example, in this case, Aussie versus US dollar. Yes, Aussie is strong, but if US dollar proved to be stronger, example, if the Federal Reserve starts to increase interest rate, that will make it relatively stronger than the Aussie, then possibly we could see the Aussie dollar heading downwards. Oh, yeah, why is Aussie dollar so tough against the dollar? It is, so like I say, it is provided the dollar is strong, then it will make Aussie dollar appear weak. But if the dollar is weak for whatever reason, then relatively it will make the Aussie dollar appear strong as well. So if you see that Aussie dollar seems to be holding out well against the US dollar, it could mean the US dollar is not as strong as the Aussie at that point in time. So of course, why the dollar is not as strong in this year, especially if you recall towards the end of last year or towards the very early part of this year, the start of this year, the rate hike expectation is 3 times in 2017. So that's a pretty aggressive rate hike. And we are now towards another month will be the end of the first quarter. So there are only 4 quarters in a year. So if Federal Reserve don't increase interest rate by the first quarter, that means they have another 3 quarters to increase interest rate, which means the frequency would be higher. So as things goes by towards the January and February with Donald Trump, president, mentioning he doesn't favor a strong dollar, and also from the policies he's announcing, causing a lot of uncertainties. So market has started to speculate maybe Federal Reserve will not taper as fast as what they expected. May not be 3 times, they are scaling their expectation to 2 times. So imagine last time when they buy into dollar expecting 3 rate hike in 2017. Of course, if the expectation now drops to 2 rate hike, there will be certain sell-off in the dollar to price out another rate hike. So that's the reason for January until current date, dollar has considered been weakened compared to the end of last year due to a rate hike, due to scaling back of rate hike expectation. Okay, there's a pretty long explanation for a bit on fundamental side to explain the Aussie and the US dollar side. The next question, what made me decide where to enter the entry point with the rectangle? Okay, a bit explanation on this example. The orange area is the area where I feel that market is trying to make a decision whether to go up or go down. That will be somewhere in the orange area. Of course, slightly beyond the orange area, if it goes beyond the orange area, to me, market can still change its mind anytime. That's at least how I look at the market. So of course, I want the market to move further into the direction and close before I look at it as a confirmation that the market has made a decision to go in that direction. So for example, if 0.7685, that area over there is a point whereby market makes a decision. So as prices creep upwards to the area between the orange box and the green box, I can only suspect maybe market is going up. So I'm a bit conservative, because at that point in time, to me, the market can still change its mind anytime. So I want the market to give a further push upwards and close inside the green box or higher before I treat it as a confirmation. Then I'll go in to long, expect it to go higher. Of course, even though I look at it as a confirmation, market can still prove me wrong. That's the reason I always put a stop loss regardless of what trade I take. So if the market really reverses, then I'll cut my trade and move on to the next trade. So for a simple so-called logic on how to put a stop loss, for this example, if I have gone in for a long trade in the upper green box, the immediate lower green box would most likely is the area where I place my stop loss, very conservative. And if the lower green box is where I enter, then the upper green box is where I would place my stop loss. So as you can see, it is a pretty conservative, pretty aggressive stop loss, pretty tight stop loss. It is about maybe 10 to 15 pips kind of range of stop loss. So similarly for the bottom entry, yeah, the same so-called criteria, I will apply it to the bottom trades as well. Wow, that's okay. Thank you for the participation. There are a lot of questions. I like it. I'll answer all the questions as they come, instead of moving on to pairs and pairs without you understanding my logic. So I'll take the question until I finish all the questions, then I'll take on the next suggestion. Hope there's no violent objection to that. How do we derive the number of pips to trade on? Is it based on news or currency pair? Of course, if you ask a different trader will have a different set of criteria, but I'll share with you my set of criteria. So how I determine the number of pips, it is not fixed even for a currency pair or a time frame. It means that it can change even for a single currency, single time frame that I'm trading. Example, Aussie Dollar H1. Maybe for this trade, as you can see, the stop loss is about 15 pips plus minus. And the next trade, maybe 2 days later or even 1 week later, my stop loss could be 25 pips or even 30 pips on the same 1 hour chart. So what I usually do, I let the chart tells me how many pips to take based on the volatility of the currency pair at that point in time, because the volatility of the currency pair changes along the way. So certain times the same currency pair may be more volatile than other time. So that's the reason I don't really use fixed pips. If you have noticed the way I put my boxes, usually the distance is about 0.5 cm away from the decision area. So I know this is a bit discretionary to some of you. Is this what is 0.5 cm? I have I have shared my trading methodology last week. The entire week I've traveled to Singapore, Malacca and KL to share my trading methodology with a group of traders from our partners. So anyway, why I use 0.5 cm is because 0.5 cm will take into consideration the pair that I'm trading, the time frame that I'm trading, and the volatility at that point in time for the currency pair. So 0.5 cm will be fixed throughout my trading. But if I'm trading a daily chart, 0.5 cm could be 30 or 40 pips apart. But if I'm trading the M1 chart, for example, 0.5 cm could be just as little as 2 pips. So for those of you who have traded a multiple time frame, you'll know that if you put a 2 pips on the daily chart, you can't see the difference. Sometimes even for a 30 pips difference, it looks a 30 pips on a daily chart will look like a 2 pip on a 1 minute chart. Okay, because for daily chart the time frame is higher. It means it will show a greater volatility of the instrument or the currency pairs. So if the volatility is higher, you tend to set a wider stop loss or take profit for your trade. Okay, so hope that answer your question. I don't really have fixed pips. It depends on the currency pair, the time frame, and also the volatility at that point in time. So because of these 3 variables, after trading the market for so many years, I realized these 3 variables keep changing. So it is very hard to pinpoint a fixed pips to it all the time with 3 variables. Okay, so now I'll move on to the next currency pair that I see on my screen. Not so much of currency pair. This is a NASDAQ, which is a US index. Okay, let's look at NASDAQ. Okay, this is NASDAQ. I'm going to put on H4. This is a H4 chart. So as you can see, not only NASDAQ, even Dow Jones, basically the US equity index has been on a rally to an all-time historical high. So of course we don't have a very long history of charts, but just look at this monthly chart for NASDAQ. It is since 2013 has been going up and away. So of course this is a long-term 2 years perspective. But let's look at a shorter term perspective for NASDAQ. Of course the main reason of all the equities heading upwards. It's because the market is buoyant about Trump policies, fiscal spending, and things like that to boost the economy. And whatever policy that Donald Trump, the new president, announced is pro-business. And the upcoming one, of course, yet to announce any details, are the tax cuts for companies. So if you announce something fantastic, that means the companies doesn't need to pay as much tax, and of course it will be good for equities, good for the company shares, etc., pushing the index higher. So at this point in time, of course, for index, there's always the fear of a bubble and things like that. Index measure value of the companies. So yes, the value of companies can go higher and higher, but at any one point in time, there's always a region whereby it becomes overvalued. So similarly, since Nasdaq measures the value of companies collectively, of course, if you add up their value, they come to a point whereby it could become overvalued. So when it becomes overvalued, chances is that there could be a sell-off, pushing price downwards. And if you look at the current chart, it has been going up and up and up. And when the higher it goes, the bigger the correction may be when it comes to equity market. As you can see over here, if I scale back the chart, you will notice price go up. It is quite a gentle move, consolidate, and then correction before heading higher up. So once it is slowly creeping up and higher and higher and higher, again there's a correction. And then now the price is slowly creeping up higher. There's a small correction, goes higher. So there could be looking at the historical price movement, there could be a bigger correction before it goes higher. So of course, if you are a counter trend trader, then you could apply your counter trend strategy to take a short trade anticipating a correction. But unfortunately, I'm not a good counter trend trader, so I have no suggestion for you when to take a counter trend trade. The only best option that I know of is to apply a divergence to look for a reversal pattern. But I shall not give you any suggestion, since that is not something that I'm good at or I'm personally doing. So for Nasdaq, I'll be still trading along the trend. I prefer to go with the trend, and this is the two areas that I possibly would look for a long entry. Okay. Just give me a moment. I'll mark the region. Oops. Enter too much figure. Okay, that is the two areas that possibly I will look for a long opportunity. Okay, once price retrace towards the green box, So basically I will rely on candlestick patterns, bullish candlestick patterns to go long. Okay, so this will be my comments for the Nasdaq. At this moment, I'm still going long, looking to go long. Some of you may be thinking, oh, if Federal Reserve proceed for a rate hike, that will be not so favorable for equities. Yes, the straightforward answer, whenever Federal Reserve increase interest rate, by right it is not a favorable news to the equities market, for simple reason. When they increase interest rate, the borrowing cost goes up, meaning all the company, if they have borrowed money from the bank, they need to pay a higher interest. But if Donald Trump announced policies that are pro-business, so all these policies possibly could so-called net off the effect from the rate hike. So even if a Federal Reserve really increase interest rate, the impact on the indexes may be limited. Yes, there could be a sell-off momentarily after the rate hike, but eventually if the so-called pro-business policies are still ongoing, the businesses should still benefit from it, and investors most likely will be attracted to buy at a lower price, thereby pushing the indexes up again. So I do foresee the uptrend in the indexes to still be continuing. It may not move as sharp as or as much or as fast, but chances is it will still have a gradual curve, at least at this moment, based on what we are seeing. Unless President Donald Trump failed to deliver what he has promised, then of course, if he say he's going to have a tax cut, but he say at the end he's going to scrap the idea, then of course that kind of announcement, possibly we could be looking for short opportunity instead. But until that time comes, then we will look at the chart again. So that will be in Nasdaq for me. The next currency pair would be Euro Pound H1. Oh, there's a comment by Sharil Osman. Hopefully I pronounce your name correctly. I followed your method and it works. Good. Congratulations. I don't mean to sound arrogant because I use it and I'm still using it. I wouldn't say that it will work all the time. Please have money management. Yeah. So of course, for me, as long as any method that works 60% of the time for a risk to reward of 1:1, that to me would be a fantastic system already. Or if the system only works 40% of the time but have a favorable risk reward of let's say 1:2, every time I risk 1, I make 2 in return, then possibly that is a fantastic system to me as well. So anyway, let me move on to the Euro Pound. Yes, let's look at Euro Pound. Euro Pound H1, please. Yes, let's look at Euro Pound H1. Okay, this is Euro Pound. H1 just had an interesting head and shoulder. If some of you have or has been trading chart pattern, Euro Pound just about 4 hours ago, 1 2 3 4 5 hours ago. This is basically a head and shoulder pattern. Okay, I will draw some lines to illustrate so that you know what is head and shoulder. So the head is in the middle, which is higher. The shoulder is basically on the left and the right side, where the price bounce up and goes lower. So this is a typical head and shoulder pattern. Head and shoulder is a bearish pattern. So the line that I drawn at the bottom is what we call the neckline, which is like a support for this head and shoulder. Around 0.8530 plus minus. Okay, it is area as well. So typically for head and shoulder trader, once the price closes below it, they'll go in for a short. So my typical way is I would prefer the candle to close in the green box. Okay, this is the same thing, regardless whether it's head and shoulder or whatever. To me, neckline is also like support resistance, means it is making a decision whether to go lower or go higher. So since this is a decision area, as you can see, about 0.5 cm lower than that will be the green box. So as long as candle close in the green box or lower, that will be my confirmation signal to go short. Okay, unfortunately this is the candle now, and the price is already moved about 8 pips lower than the intended entry price. So to me, I don't have a habit of running after the market. So meaning if I miss these 8 pips, then I will ignore it. The only time that I'll still enter, even though the market is 8 pips against me, that means the market already moved 8 pips ahead. The only time that I will still enter the trade, provided I'm trading a daily chart or higher. I have not trade any chart higher than daily, but theoretically, if I trade the daily chart or any time frame higher, if the market has moved 8 pips, chances is I don't see much of movement on the chart itself because of the time frame. So 8 pips on a daily chart is just a tiny bit of movement. And the trade on a daily chart could be 200 pips or 300 pips kind of stop loss. So 8 pips difference doesn't make much of a big difference to the risk reward. Okay. But for this case, because it's an hourly chart, as you can see, the 8 pips seems like pretty far away from your entry price. So I personally will choose not to enter this trade too far away against me. So if I enter, the risk reward for this trade will not be in my favor. So if it goes anywhere lower, then I would have missed this trade. But for learning purpose, this would be the typical head and shoulder pattern on a Euro Pound. And then for stop loss, okay, since I'm talking about this trade, might as well cover everything. For stop loss, aggressive stop loss would be somewhere here, just above the neckline. So the red area, anywhere around that red area is what I call aggressive stop loss. Aggressive means it's tight, very small. For head and shoulder, typically I don't like to put a tight stop loss. Reason because I have observed the market for head and shoulder. There are times whereby it could retrace to this kind of levels after price broke the neckline, and then it retraced back up to somewhere the red level, and then before heading downwards again. So for head and shoulder, I personally would refer to 1 or 2 candles before the break. I will refer to the breaking candle or 1 or 2 candles before the break, depending on how far it is. So in this case, as you can see, this bear candle is the candle that so-called break the neckline. And 1 candle behind it, there's a tail over here. So my typical stop loss is higher in that area. That means higher than the high of the 2 candles. So somewhere in the upper red box, which is about 8550 thereabout. Yeah, plus minus 1 or 2 pips. Okay, thereabout. So if my entry is in the green box, my stop loss is here. This is typically about 25 to 28 pips kind of stop loss trade for Euro Pound. So this is a Euro Pound. Let me look at one last pair before we end off tonight's session. Okay, there's a question on the head and shoulder. Assuming that if we did enter the trade earlier for this head and shoulder, where should we set our TP? Typically, for me, I don't really set TP for trades. And even if I set TP, I look at support and resistance to set my TP. So if I look at the current chart, the first area that I would suspect is somewhere here, and this could be my first target. Where the green box is, usually I set my targets before it hits to the decision area. Or even if it's closer, it's fine. Yeah. So the green box or green area is where I will set my first target. So if you measure this is also about 26 pips away. So if my stop loss is about also 26 pips, this is about the 1:1 risk reward. So once it reached the first target, then I have the option of either do a partial close or I close it completely, depending on your personal preference. So if you expect the price you want to do a trailing stop, then of course you do a partial close at the first blue box and then trail it lower. And of course, if you want to leave the entire position there, the bare minimum I would do if price reaches the blue box is to shift my stop loss to my entry price, or log in about 2 to 3 pips. In this case, this is a short trade. Typically, I would shift my stop loss 2 to 3 pips lower than my actual entry price. Okay, I will take the last pair for tonight, then I will clear off any outstanding questions on my screen. Aussie Swiss franc day 1. Well, we have a good mix. We have looked at H1, H4, and now daily chart on Aussie Swiss franc. Let me look at the Aussie Swiss franc. And the request is on daily chart. Okay, let me check through the vertical line first. Yeah. Okay, so this is Aussie Swiss franc daily chart. As you can see, the trend is also, yes, the general trend is upward trend, but the so-called retracement can be quite significant. Okay, as you can see over here. So when price move up, there's a big drop and then move up and then consolidate, and then there could be some volatility. So general trend is still slightly creeping upwards, but the volatility could have a big retracement as well, just like what this chart is telling us. So the predominant trend is still up since mid of 2016. The most recent one closer to 1 to 2 months period, which is over here, this part of the chart. Definitely it is still so-called over here. As you can see, I'm drawing the trend line just to give you the perspective that it is going up. And the key resistance over here has been broken about a week ago. Okay, that's the 50 number. So some of you prefer round numbers like 50. This is fine as well. But if it's slightly lower, 40 is fine as well. But some of you will say, Wayne, that's 10 pips. It's not small. There comes the perspective when you are trading daily chart. 10 or 20 pips is like 1 to 2 pips on 1 minute chart. Okay, that's the perspective of the difference, the main difference between a higher time frame and a lower time frame. So as you can see, there's a big drop and price is moving higher now over here. So if the price failed to go higher, start to come back down, then once he made another so-called bullish candlestick pattern around 0.7640, okay, the green box is for reference. When the price retrace below and then bounce up, it depends on the bullish candlestick formation. So if it is a bullish engulfing, it means after the bull candle, where is the start of the next candle before you enter. So it could be in the green box or could be higher. Then that would be my signal to go long. So alternatively, some of you may find candlestick patterns is a bit too subjective. There's a lot of gray area where to look out for, or you prefer a more objective way. Objective technical analysis is always relying on indicators, give you numbers, which is a very objective way of trading the market. So just to give you an example of an objective way of trading the market. So based on the price action, I'm looking to go long on Aussie Swiss franc, maybe around the area of 0.7640 or higher. So if I use the stochastic, for stochastic, the buying signal comes when the stochastic goes to oversold region, which is marked by the green box. So once stochastic drop below the level 20, that is a buying signal for stochastic. So if you want an objective way, you wait for stochastic to drop below 20, and when it comes up, that will be a buying signal for Aussie Swiss franc. Then of course, when you are trading the daily chart, the chances of this setup would be easily could wait for a week or two before it happen, if it does happen. Yeah. Because a week or two is only 5 to 10 candlesticks. It is not really that many candlestick formation for a 2 weeks period. Okay, so we have covered most of the requests. Again, due to time constraint, if I can't answer your request, my apologies. You can type in your request faster next time. Anyway, let me quickly scan through the questions and see if I've missed out any important must answer question. Of course, if you find that you follow my method, has you good results, do drop me an email as well, wayne@fullertonmarkets.com. I like to hear good news. If you are making, of course, no worry, I won't ask you to buy me a dinner. But if you offer, I won't reject as well. Yeah, there's a question. Usually I know after the news the graph becomes volatile. Yes, because especially for important news, when before the data, the entire market is waiting for the result. Of course, when the result is out, everyone starts to trade the market, which causes the market to be volatile. Of course, it doesn't mean all the important news, because if you go to any news calendar, like example in fxstreet.com, they have a news calendar. They rate their news by the color. Some are white, some are yellow, orange, and red. So based on the color coding, red color is the most important. Of course, the white is the least important. But having said that, it doesn't mean some of the yellow coded news and some of the orange coded news are not important. It depends on what the market is focused and looking at. So at times, even the red coded news, market may not pay much attention to it, especially if the actual data when they release is more or less what the market has expected. So if the market has expected that kind of result, the market may not move as much as we would like it to be. Okay, a comment, my jokes ain't getting any better. Yeah, thank you for the compliment. I'm not really that good at cracking jokes, so my apologies. Okay, time flies. We have come to the end of this week's webinar. So I hope every one of you have enjoyed yourself and find the information that I've shared useful and set you up nicely for the week. So I look forward to seeing all of you next week, same time, same channel. And I wish all of you, may the pips be with you. Make a reasonable profit out of the market this week as well. So this is Wayne, Head of Research and Education, signing off. On behalf of Fullerton Markets, I wish everyone a good night and bye-bye.